Under the intra-group consolidation journal entries, I want to focus on Journal 4 and 5 that eliminates the intra-group dividend declared by the subsidiary. Something you have to note here is that the dividends were both declared at the end of the year. At that point in time, the parent and the non-controlling interests are the shareholders of S. So that full dividend was declared to the parent and to the non-controlling interests. So the parent recognized income, their portion of the entire dividend declared by the subsidiary, as they are now shareholders of S when the dividend was declared. So Journal 4 eliminates the ordinary dividend, the full dividend, the parent's portion against dividend income eliminated in the profit of the group, and your non-controlling interests show a debit movement for their portion. Same for the preference dividend, the full dividend eliminates. The parent recognized their portion as other income, which has to eliminate, and your non-controlling interest show their debit movement as they've received something back that they are entitled to. Because these dividends were only declared at reporting date, you still have shareholders for dividends where the subsidiary owes these amounts to the equity participants. But for intra-group consolidation journal entry purposes, only the portion owed by the subsidiary to the parent represents an intra-group balance to eliminate, so we eliminate the liability shareholders for dividends against the assets dividends receivable, and the amount of 14,500 is only the amount owed by the subsidiary to the parent, which is that 4,000 Rand plus the 10,500 Rand, representing the dividend owed to the parent. The portion of the dividend owed by the subsidiary to NCI is not considered an intra-group balance to eliminate. The rest of the intra-group consolidation journal entries relates to the elimination of the intra-group income and expense items as well as the intra-group loan. This is some revision of what we did in chapter 4, so please have a look at these consolidation journal entries. The next category of consolidation journal entries we will focus on is the since acquisition consolidation journal entries, and this is where we measure NCI. Now, with an interim acquisition in that year only, remember your opening balance retained earnings will only include the retained earnings of the parent. The retained earnings opening balance of the subsidiary got eliminated in the at acquisition date consolidation journal entries. So the only movement in retained earnings of the subsidiary that I need to attribute further to NCI is the profit for the year, and specifically the profit since acquisition date. The retained earnings opening balance of 7,500 eliminated in the at acquisition journal entry, and a portion of that was attributed to NCI. The first 3 months profit was eliminated at acquisition date and was attributed to your NCI through the at acquisition consolidation journal entries. So that has happened. The only portion of the retained earnings for the year that you still have to attribute to NCI is the since acquisition date profit. That's why you only have in this example profit attributable to NCI that you increase the NCI balance with, and we have 2 journal entries because we have ordinary share NCI and preference share NCI. To calculate, you always start with the profit of the subsidiary. But when you have an interim acquisition, you can't merely take the total profit in the TB. You start now with the profit of the subsidiary since acquisition date. This amount was calculated when we did the split. Only the since acquisition date profit of the subsidiary is allowed to be in the group, and therefore only the since acquisition date profit of the subsidiary can be attributed to the equity participants. Because we have preference shares, we always have to ask, who is that attributable to? And a portion of that since acquisition date profit of S is attributable to the preference shareholders, but not the full 10,000 Rand. The preference dividend accrues over time. At the acquisition consolidation journal entries, you've already attributed 2,500 of the total 10,000 dividend to the preference shares in the acquisition consolidation journal entry. So the only portion of the since acquisition date profit that is attributable to the preference shareholders is the 10,000 total dividend for 9 months, which gives you the 7,500. That is moved from the profit of S before we attribute to the ordinary share NCI. And that 7,500 that you've just removed from the profit also needs to be attributed, but based on the preference share percentage holding. So now the 7,500 is attributable to the preference shareholders in their 60 or at their 60% percentage holding. Profit attributable to NCI in the consolidated SPLOCkie will now be the total of these two amounts added together, giving you an amount of 38,214 Rand, and you can have a look in your consolidated SPLOCkie. You'll find this amount there. Please note that you did attribute the full 10,000 Rand fixed annual dividend to your cumulative preference shareholders. You only split it out. 2,500 was attributed to the preference shareholders at acquisition date, and 7,500 was attributed to your preference shareholders since acquisition date.